Hey everybody, it is Saturday, December the 10th, 8 o'clock in the morning, and I decided, it's been a while since we did a weekend update, and considering where we are, what we've been through, and the time of the year, I hate being inside my head this time of the year, so I figured I'd get busy, occupy my time, and do something that could make the world a better place. And here we are. Uh, Looking here into Friday, again, that very end of the day, last final hour, how they pulled the rug out there. Uh, Again, that's why I threw that alert in the email and also out there on Thursday that, yeah, we're closing green on Thursday. No question. That's why I went large on my spreads. Even took the risk of rolling some of those spreads from Tuesday and Wednesday. But yesterday, again, closed red. One green close, one green close, two green closes, one green close, one green close, two green closes. And one of the things I want to bring out and why I'm going to table pound this again is all right, like here, right? On November the 10th, this is your CPI. We moved 207 points on that day with a gap that never filled back here to 37.48. 207 points. We moved 122 points the day that Powell spoke, November 30th. And here we are doing nothing. And another one of the ones I want to look at here, how I highlight in blue, how the range is less than 50 points, really less than 45 points. We've had all of these small ranges all during this 10% rally from that 36.98 in November up to that 4100 where we started the month out. And as of Friday, we closed down 3.74% on the month. We were down 117 points from the open, 136 point range for the week. And again, I'm not a magician or a fortune teller, reading tea leaves. I'm good at what I do because I've taken the time to get everything I can get to put it together so that I can be good at what I do. Nobody's going to be perfect. Nobody. But you want all the tools to your advantage. And this is why, again, I table pound doing these spreadsheets. I don't know how many of you play golf, all right, but I'll use the golf analogy. This is a standard trader. He's playing golf. This is a trader who actually writes down every single stroke, what the wind was, what position it was, what time of the day it was, and that's the reason he's a fucking champion. This is your other champion doing it, writing it all down, taking all the stats down, and he has someone helping him, aka his caddy, who's telling him, "Hey Phil, the last time we did this and the wind was blowing virtually the same, what you did was this, and that's why this time you might want to stroke it a little bit different. Last time we played on this course." All of that data, all of that information, his caddy has that to help him out with. And then this is the other guy who doesn't write anything down, but he's bought a bag of golf clubs, he's paid the fees to go out there on the course, and he says, "I'm a golfer." Again, comes back to where I learned it from when I met Jack Nicklaus back in 1988. Told me the same thing. If you ever want to play golf, write down everything that you do and you will be a champion. And then here's what you got today. This is 99% of traders that are out there. And they're saying, "Yeah, I'm a trader. I'm a trader. I am. I'm out there. I got an account. I got money in it. I'm pushing buttons." And then this is FinTwit. This is your stock twits. This is your Twitter. This is your Facebook, option pages talking about what's going to happen here, what's going to happen there. Now, get into your spreadsheets, do them. They are free for everybody. Everybody's got Google Sheets. And more importantly, you have the ability there where you have Yahoo Finance, You can go over there, look up the historical data as far back as you want. I don't think that you need to go that far back because you're trading the relevant data right now. Pull up all your data, figure out what columns fit for you. I've got a couple secret columns here that I don't like to show because that's how I make my alerts. That's how I pick my trades. But you have all of your data. I've shared this with Suresh. That's why you see Suresh talking about the full moon, talking about the range for the month, the range expansion. Why we knew we were going to be going higher back in November because we've got all the data. So, enough of that. What I want to go over here and do is I want to look out at some wider views, into shorter term views, into what is the risk of being long heading into CPI and heading into the FOMC meeting. So this is your ES chart. I've chosen the ES only because all of my SPX charts are filled with drawings. To do this, I just spent about 45 minutes removing old drawings because this is one that I used to call Q4 2017. I had an enormous amount of data on this. I went over and I deleted it all, and I just left it out here clean. Now, again, I am not a trend line guy. I'm not. I've said it before with trend lines, I believe number one, your trend line needs to be drawn to the actual point and to the actual minute. And when it's done like that, it's only applicable to be used as a table pounding trend line when you are looking at a 1 minute chart. If you're looking at a 5 minute chart or a 15 minute chart or a daily or a weekly, that line is going to move around because you've drawn it accurately. So it's not going to give you the same place where you're going to. But with trend lines, especially when you zoom out, you do get a pretty decent broad picture. And that's what we're looking to do here today. Uh, Here, coming off the 2008 highs, going into the 2018 highs, came right up there to that second 2018 high almost perfectly. Resisted it over here in December 19, resisted it again back there in June 2020 after we popped above it, supported on it, and now here we are again, just coming right over there and supporting right there to it. But that's not what I have this chart up here for. Now, if you bear with me, we're going to zoom in. Just going to zoom in a little bit. And what I'm looking at here is December, right? So like here, right here is December of 2009. We had hit our bottom back there in March, and here is your December of 2009. And as you can see here, the first week, the second week, little bit of a dip off of that year-to-date high, because or that month, yeah, that year-to-date high over here in November that posted right at Thanksgiving, had your little bit of a dip, and then as you went into that Christmas week, the final week of the year, higher, higher, and then in the beginning of January, you had your dip back down, which was lower. Come over here and scroll, and I don't want to make anybody sick, but yeah, again, over here into November of 2010, you had your highs over here in the earlier part of the month, your little bit of a dip as you went into Thanksgiving, and then December just cruising upwards on the weekly candles here, all the way up until February before you got your little dip. Again, different time of the life when we were back then as to when we are right now. This is 2012, 2011. We were already coming out of the dumpsters back then. Right now, we're trying to figure out where we are, having run as high as we did. Again, here, November of 2011, had your little bit of a dip here during Thanksgiving, and then slowly trotting higher as you went in here to November, not taking out the highs. If anybody who does Elliott waves, you know that this right here, May of 2011, was the wave one up from the 2009 lows. And then you had the wave two low that came down here. And as you can see, the trend line almost coming into place there, the trend line, which again is why this was your wave one high, this was your wave two, and then wave three went all the way into 2018. Sorry to scroll so fast. 2012, same thing. Little bit of a dip there in November, and then higher, higher, higher as you went into the end of the year in 2012. Different point of the year, again, different time. I'll show you again when we go into some other charts about the NASDAQ. But then again here, 2013, had your low dip right here back in October and then just rallied on through into the first week of December, little bit of a dip and then higher as you went into the end of the year. Again, here we're coming into 2014. 2014 was when we went into our flat plateau. We started to go flat right after 2014. I'll show you here. We put in the highs back here on the week of Christmas, of December 22, 2014, right up there, fractionally below where we had begun, where we expected to go above that. And then in 2015, we literally went nowhere until we had that. Everybody calls it the Lucy, the Lucy drop. If you've watched the movie Lucy came out, and all of a sudden the algorithm back here in August, from nowhere, from absolutely nowhere, pulled out the rug, and you had this massive drop to the downside. Your highs posted here in May went absolutely nowhere, and I still recall right over here in December, this was the very first rate hike that we did. It was the very first rate hike that we did. And from here over in May, we didn't really go anywhere and we didn't actually drop below any lows. And then we came over here into December or February of 2016. February 2016, many people remember crude oil had dropped from $110 in 2008 down to 25 bucks. And right here on February 10th, 2016, was when they went and made an agreement. OPEC finally agreed, and that was when we hit our bottom there in 2016. But again, 2015, fractionally playing around, not really moving anywhere when we were in 2015 with our first rate hike from Janet Yellen, had that plateau top, nothing to be aware of or really concerned. Here you are in 2016, Trump got elected, had your big candle, went over here, posted the highs of the week, this week coming over here December 12th, and then just kind of plateaued into the rest of the year. Come into 2017 never stopped. Never stopped, never stopped, all the way up into January 2018. Then we had our first little dip, 14%. Went up into September. Then we had our 20% dip. Hang on. Excuse me. This was the December that failed, the December 2018, and we knew it was failing anyway, because as you can see, when you were projecting for a very long period of time that we were going to be getting our down, we got our down. We got our perfect A, B, C all the way down and just came right around. Let me see here if I remember the 138. Yeah, right to the 138. And this was on Christmas Day or Christmas Eve, and December 26th was when the lows got posted here. And that was what we had thought was going to be our wave 3. This was our wave 4 as we went into January, and then we were going to get our wave 5 to go lower. That never happened. We had the PPT with Steve Mnuchin out there calling everybody to start buying everything up, and then you had your FOMC meeting here in January where they said we're not going to raise rates anymore. We're going to start cutting rates. And we had our run. And as you went in here to 2019, you had your run and you went higher. All the way up into the end of the year, we went higher. Then you had your COVID. COVID came in February. Bang, you had your COVID drop. COVID was so bad that over here, by August, we had already taken COVID out. We were on the way up. Support lines you can see here drawn. You can see all these lines that are drawn from when we zoom out. But again, coming in here, November, going into December, as you can see, just continually going higher into the end of the year, even though we had our little dip here in the very first week of December. Come over here into last year, we had our very dip right there into November. Then we started to fractionally work higher as we went into the end of the year of 2021. And now here we are where we are right now. And everybody looks at this and wants to zoom out and say, it's exactly like this. And they want to zoom out and say, it's exactly like it was back in 2000. And again, I bring you back, that's where it's coming from. It's coming from here. It's coming from FinTwit is where it's coming from, where everybody's calling those things out. So where we'll go over here and show you is on your NASDAQ. And a NASDAQ, as you can see here, Your dot-com highs came over here in, obviously, the dot-com 2000. You didn't break above these dot-com highs until 2014, 2016. It's 2014 on the NDX, 2016 over here on the NQ. But again, you see how this pattern of where we are and where we're going compared to the ES being with its trend lines and with its distance of how high it ran. We ran exceptionally high over here with everything that we were going with the NASDAQ. And because the NASDAQ weighs so much and because it is holding us back so far, we are at a very restricted period of being able to actually explode and start moving to the upside due to the fact that the NASDAQ is so depressed. It's in a fantastic value zone. Don't get me wrong, being here between 13,000 and 10,700, but it is a very depressed index because of, for example, you've got Amazon, you've got Tesla, you've got Google. They're all 50% from their all-time highs. NVIDIA, 50% from the all-time highs. The index is down here 30% from the all-time highs is where we're resisting that 286.10 over there on the QQQ. But again, with this trend line channel that you can kind of be looking at here, it's just very, very interesting for those of us in the Elliott wave world because you're holding this channel here. And as you can see, when we came down right to the top of that channel and we're supporting it. And again, with the channel being that it's a rising channel, you would expect that eventually you are going to get a test onto that channel. But again, it's going to be a rising channel until you actually get the rug pull that's going to be going lower, which in my opinion isn't coming until next year. And again, pull over here onto the VIX. This is looking at the VIX from a very wide point of view, so I'm going to zoom out a little bit. Here's your 3-year, so you can see where the lines come from, more or less. So I'll zoom you in here just on a 360. And as you can see, with this lower trend line, again, this was why I began starting to get a little bit bullish looking forward to this. And we've got that upper resistance up here now. So this support level, this 2102, theoretically should not fail, despite what we have with CPI, with the FOMC. So, again, just looking here from a VIX point of view, and as well as looking at what I've already shared with what we've got going on as we started into the week, with this being the 1 and the 2 and failing to get above that 418, it's not over yet. All right, it's not over yet, where the bear B is looking somewhere down here in this 38.50, 37.50 area. If this is to be an ABC, where we failed that 418. So what we're needing to see is, as we have not broken below this 39.11, even though we are threatening it very, very strongly, if this does finish and does hold, that this is our 4, then we are undoubtedly looking at that seasonal trend from the Decembers, where from here, this being our 4, we should be looking at our 5 somewhere up in that range as we go into the end of the year, up around that 4150, 4200, 4250 area. So again, going back to the data itself, 1 second, I'll pull that up there. Just going back to the data alone, the data wants to tell us that we are still selling any kind of positive move that we are getting. We're going to go over here and you're going to look at your chart, and your chart is telling you that for 3 weeks you have been holding in this area, which I cannot stress is bullish in and of itself. You come back over here onto your data, and your data is showing you that on Powell and on CPI, which is again Powell, you're getting massive moves. So The only other thing that we can come down to is to come over and start looking at a little bit of a technical inflection. And looking here at the RSI on the daily, yeah, the RSI on the daily is saying, yeah, I want to go down. You come over and you look at the RSI on the weekly, and the RSI on the weekly has been continually heading downward with lower highs. It's not suggesting that it wants to go down, but it's definitely pointing to the downside. And when you come over and start looking at the shorter time frames, which is where we trade off of, here on the 4 hour with the move that we had down here, we now have ourselves a buy divergence on the 4 hour pending if we do get a little bit of a dip or another red close come on Monday. So again, we are looking very decent odds that we could get a CPI spike and a CPI rally and a move off the FOMC up into this 4150, 4200, 4250 level as we head into the end of the year, beginning of next year. But by all means, don't get me wrong, because if we do get up to that, then that will wind up being our A. And then we are getting a B, which is going to be a little bit greater. And using common sense, the brand new year, you've got a lot of tax loss selling that'll be taking place between January and March. You'll have earnings season coming out with everybody guiding to the downside. You've had consecutive 0.75 rate hikes, which take a little bit of time to work themselves into, the economy. So yeah, come January, come March, it's going to be pretty fucking bearish. So a little bit higher, fractionally higher up there, that 4100, 4200 level, it's in the cards. It's definitely in the cards. We lose this 3,900 level here. There's no question. You're looking at 3,700 to hold you for support. And if you fail that 3,700, you're looking at the lows of the year again. But I don't even look at that as a focal point. I just look at it as a very strong possibility, but it's not there as a focal point as of yet. Still looking for higher highs before we are going to be looking for higher lows. That's the view that I have for the meantime. And until we see some otherwise reason to send out an alert, that's what we're looking at. So listen, I apologize for wasting anybody's time if you went through that and said, well, that was just a bunch of shit. But, that's the weekend. So I'm just trying to show you how things work, what's worked for me, why I haven't had to work for anybody for 21 years. And again, why, other than that one day on Tuesday, and you can go back week after week for months, why I'm green every day on the SPX credit trades. So have a fantastic weekend and get rested because we're going to have a very busy week starting Tuesday.